This is coming soon. That starts this month. There should be a recession in America. So people are now, it's totally fine. Look at the market. It's near all-time highs. But is it really? If you were to pull out the top 7 stocks, when you see the numbers on this, it's staggering. And on top of that, there is an indicator of when a recession actually hits. And it isn't while we're raising interest rates, the Fed. It happens after we stop raising rates. And wait till you see how long it takes for the market to crash. And by the way, I got a bunch of other data to share with you, but I've learned one thing for sure. Having been in the financial industry since the day before 9/11, only the paranoid survive, and those who are way too confident are typically wrong, and those who are way too cocky are also typically wrong. So here's U.S. interest rate hikes in the history of America. When we raise rates, we have never raised 4.88 percentage points as quickly as we did in the state. Nothing comes close to the 22 to 23 of 4.88. But what does this really mean? So if we look at the balance sheet of, this is pretty much the quantitative easing balance sheet, that shows how much bonds the Fed is buying. The M2 money supply shows how much money is circulating in the economy. So you notice, look how historically it's gradually climbing, but it's nothing that's sudden. Then all of a sudden, boom, we feed the economy, the market, with trillions of dollars we're not accustomed to, and we don't have another case study for somebody to say, well, here's what's going to happen. Well, it's totally okay. Well, don't worry about it. Based on what? Based on what case study can you speak so confidently saying nothing's going to happen? Everybody is almost protecting whatever business they're part of, investment they have. They're trying to sell why they're right and maybe don't worry about it, or do worry about it. But the reality of it is nobody knows 100% what's going on because we've never been here before. So let's continue. What's next for the U.S. economy? They did a survey to find out who thinks a recession is coming. The Fed staff says 0% there's not going to be a recession. I remember they're in the business, so they're supposed to be saying that because that is Wall Street, right? Yield curve says 61% chance a recession is coming next 12 months. Economists are at 48%. Consumers are at 69%. That's Main Street, you and I. Goldman Sachs is saying only 15%. Bank of America, 35 to 40%. But look at CEO, 84%. Okay. C-suites are saying 84%. Now, what would CEOs know that the rest of them don't know? Maybe they know their debt payment. Maybe they know when their debt payment interest rates that they got was lower, that if they have to renew the debt that they got, it's going to go up here. How the hell are we going to make those payments? Maybe we ought to look at what some of these CEOs are talking about. You'll notice the percentage of S&P 500 companies citing keywords on earning calls. What words they're using fewer times. Inflation has decreased. Material costs decreased. Economical slowdown decreased. Job cuts went up, but it's also decreased. So could this be a sign that everything's going to be okay? If yes, why are CEOs at 84% saying a recession is coming? Are they Houdini? Are they Nostradamus? Are they somebody that can predict the future? What do they know that the rest of the people don't know? Now, when it comes down to S&P 500, these are the 500 biggest companies in America. Something very interesting is happening. There are 7 companies that make up 28% of the S&P 500. Let me break this down for you. 500 biggest companies, 7 companies make up 28%. In the history of S&P 500, never has there been a time where 7 companies make up 28%. We've never had 7 companies. You know, too big to fail. What are these companies? You got Meta, Facebook, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla. So why is this important? Here's why. If you look at the S&P 500 year-to-date returns, you will notice a number roughly around 12%. Could be higher, could be lower, but it's around 12%. You know what Magnificent Seven's return is for the year so far? Roughly 92%. So what happens if you take the 7 stocks out and there's only 493 stocks left? How's the S&P 500 doing? It's down. So the 7 are pulling the rest of the market, and it looks like everything else is okay, but is it really? So we decided to break it down to see how small cap companies were doing, mid cap companies were doing versus large cap companies. And you will notice a trend here. Watch this. If you look at this chart, you'll notice 3 different funds here. One is the SPY, which is the S&P 500. The other one is the Russell 2000. Then you have the micro cap ETF. So if you look at these, the S&P 500 is companies valued roughly at 12.7 billion or higher. top 500 biggest companies in America. Russell 2000 is company sizes $300 million to $2 billion market cap. And then the micro cap is from 50 million to 300 million. So if you look at this, what do you notice? You'll notice SPY is up 18.66%. The rich get richer, the big get bigger, the stronger get stronger. Great. Russell 2000 is only up 7%. But look at the micro cap. Micro cap companies are down 1.85%. So why is that? Is it the bigger guys can afford to go through a season like this? They can weather the storm and they can kind of handle it because the amount of cash they have and capital they have and the smaller guys cannot? Possibly, but we cannot fool ourselves thinking the market is up just because these 7 magnificent companies are carrying the weight. So far, the reason why the market hasn't crashed is 1, Magnificent 7 is holding the S&P 500 high, so people are like, it's going to be okay. Number 2, unemployment is super low, 50-year low, so people have jobs, they're paying their bills, they're not really that worried about it. They are worried, but not that worried about it to the point that the market has to think about maybe a crash or recession coming around the corner. However, number 3 is something to be concerned about because the U.S. consumer credit card debt tops $1 trillion. So you may say, Pat, credit card debt, $1 trillion. I get it. It's the highest it's ever been in the history of America. It's not like that's that big of a deal. We've been spending money on credit cards for a while. Fine. No problem. But look at this chart. Tell me if this concerns you a little bit. This is the credit card interest rate. This shows you, let me explain what the differences are. Blue is the credit card rate. Orange is the 5-year U.S. Treasury. The gray is the difference between the two. So look at credit card interest rates is the highest it's ever been because as rates go higher, your interest rate on your credit card goes higher and then it makes you miss payments more. So if you had a $33,000 credit card total debt and it keeps going higher and higher and higher, your payments are getting bigger and bigger and bigger. The average person's like, look, I can afford to pay $300 a month. I can't afford to pay $420 a month. All of a sudden it went up or a bigger number than that. $420, now it's $580. But this is not a good sign of what's taking place because people's interest payments are officially higher than they've ever been before. Now, for some of you guys that are watching this, I don't want to break it to you. I got some bad news for you. You know the 30, 40 million students or Americans who were paying their debt for their student loan. Remember that whole where the government said, yeah, during COVID, don't worry about making the payments. We're going to defer this. Those things are coming back. So think about 30 to 40 million people having to pay another $300 per month. So put that on top of everything else that's going on. Another $300 a month. Now, this next one's going to be crazy because this next one, some people could say, Pat, this is why the market's not going to crash. And I'll give you the argument. Currently, mortgage rates are well over 7%, in some cases at 8%, about 4% or 5% higher than the lowest mortgage rates we had in 2022. We're around 3%. Today, we're at, say, 7.5%, 8%. Despite the sharp increase in interest rates, the weighted average rate has barely ticked up. Only those buying houses are affected by no mortgage rates, and there aren't many home buyers. So what this means is the weighted, if you take everybody's mortgage loan, everybody's loan together, and you average it, weighted rate that they have, it hasn't increased because people are not refinancing. The refi business is dead today, right? Only the people that are buying a new house are paying these new high rates, and people are not buying as many houses as they did before because people are not selling. Because those who are not wanting to sell, they don't want to go from a 3% loan to an 8% loan. You get the idea? How long this can last, no one knows, but they're still hanging on to that loan saying, I'm not giving up this 3% loan. Okay, so that was a breather. I gave you some bad news. That's a student loan you got to pay. It reminded you were kind of upset. Then I gave you some good news. This is the real news you want to know about why the market hasn't tanked. And when you look at this chart, this is the Fed funds and the lag effect, the delay. The graph below shows the Fed fund rate and the time as measured in months from the last in a series of rate hikes preceding each recession since 1981. So, meaning they're increasing the rates, increasing. Boom, they stop raising. How long did it take until recession hit? If you look at these numbers, you'll see a 6, a 15 months, 8 months, 17 months, 10 months. You know what that means? It takes roughly 11 months from the moment we stop raising interest rates that recession appears. Again, if this data is real, there should be a recession in America based on this chart. That's what should happen. Some people may say, well, Pat, how come more corporations are not filing bankruptcy? How come all this stuff that happened in 2008 is not happening today? Because these corporations, if you look at this chart, what they were doing is the money they took, companies were taking millions and billions from banks saying, go get some more money from the bank because it's so cheap. What do we do with the money? Just set it aside. Who cares? We'll go get the money. Yeah, but the rates are only locked for 3 years or 2 years or 4. Go get 50 million. Go get a billion. Go get 100 million. And they did. So what did these corporations do? They took that $50 million at 3% and they bought bonds. So the difference, let's just say the bond's paying 6%, the 6%, 3%, the 3% they're making on top of this. Okay, we're making 3% on 50 million bucks. Every year we're making $1.5 million in interest. This is awesome. We should have borrowed more money. However, if you look at this chart, you know what's coming up? Here's what's coming up. When that expires and it matures, and then it goes from 3% to 8%, they're going to be in deep trouble because they have to make those payments. They can no longer make money on that. So what do? That's when they have to say, hey, we don't want this loan anymore. Let me give it back to you. If they have the money, or two, bank's going to say, we're expecting a payment. Do you have it? Can we wait another month? Can we wait another 2 months? This is why a company called WeWork that was valued at $47 billion in 2017, where SoftBank gave it $18.9 billion investment, defaulted on a $95 million payment. We haven't seen a lot of this yet. This is coming soon. So let me unpack this lag effect of these corporations having to pay their interest on the loan that they took. Take a look at this chart. If you look at this chart, this is corporate debt maturing in billions of dollars to the left. Roughly 790 billion matures. How much does it mature in 25? 1.1 trillion. And then it goes to roughly 1.2 trillion, give or take. 2027 stays at $1 trillion. 2028 goes closer to 1.3 trillion. How are they going to go all of a sudden from 2, 3, 4, 500 billion dollars to $1 trillion to 1.4 trillion, 1.5 trillion? And this is why when we asked the question at the beginning, who is the least optimistic about recession? 84% CEOs. Maybe they know something that others don't, because they know that debt is coming. So far we've talked about, imagine the average individual's like, look, dude, my school loan I got to pay for now. Now credit card debt went up all of a sudden to the highest it's ever been. Dude, I can't afford these payments. And you're noticing the defaults right now. Commercial real estate companies are defaulting on their payments. Subprime auto finance. So those people that don't have good credit that bought a car, they're starting to default with their payments because their interest rates are going up. They're defaulting. They can't afford to pay it right now. But who else is experiencing this? These were all small things we're talking about, right? You know who else owes a lot of money? What corporation in the world owes the most money? You know what that corporation's called? The great United States of America. You know what's going to happen to them every time interest rates go up? Let's break it down for you. So U.S. roughly owes $33 trillion of national debt. Math would tell you and I that each 1% increase in interest rates pushes the government's interest expense up by, you know how much? $320 billion. Each percent. Each 3% is $1 trillion. Just interest. Increase. Not total, an increase of an additional $3 trillion at each 3%. So just to kind of put that in context, if you look at this chart, look what it shows you. This is the interest expense we've had in U.S. from 1970 till today. You know how it's gradually gone up, but it's not been anything crazy. Then look at COVID. Boom, skyrocketed. How are we going to make these payments? I have no clue, but they're going to come to you and I because it's really our debt. The government is we the people. You and I are running, we hired these people to run this corporation, but they come to you and I to fund it. So guess who they're coming to very soon? You and I. There are certain things you look at to be motivated and excited about the future. Take a look at this chart here. So again, remember this corporation we're talking about called the United States of America? Here's what this is. The green is the tax revenue our government gets every year from you and I. The orange is our GDP. The blue is our interest payment. And the red is our debt, the $33 trillion debt. Look how many years ago in 1980, everything was right next to each other. Just 43 years ago. They're neck and neck. All of a sudden, boom, the red goes off to the roof. It just skyrockets all the way to the top. GDP is a gradual growth. And guess what all of a sudden caught up to being the second highest now? It's our interest expense. This is not good news. This is why every time these guys don't want to go balance their budget, except they want to spend money, and people say, well, it's okay, well, it's okay, well, it's okay. You're just telling them, don't do your job. It's okay. Keep spending money. I'm okay with that. This is our doing because we voted these people in. You and I voted these people in, and they're managing U.S.'s finances in a reckless way.
A lot happened yesterday. One first rate cut in God knows March of 2020. However, everybody's asking, why is the market tanking? Why did the market tank in the opposite, react in the opposite way? Not tank, interest rates. 11 times in 6 months, we raised the rates. Never in the history of America have we done this. We haven't touched the rates for over a year. And the last time we lowered the rates was March of 2020. Jerome Powell making this announcement. He comes out. Everybody's expecting 1/4 point. It's not going to be anything. It's only going to be 1/4 point. We're even talking about it. You said 50-50.
I said
right?
50-50 for 1/2 point.
Yeah. And then all of a sudden, he says, nope, we're going to 1/2 point. Tom, I have a chart I want to show after you're done, but I want to hear your reaction when you saw this.
So I was 50-50. So was I super surprised? No. But was I somewhat surprised? Sure, because I was 50-50. And what everyone had been looking at, all the Fed watchers, and I get away from all the chaff and I try to signal the noise ratio. I try to get the signal and cut out the noise of a lot of the chatter. And what was in the signal was that there's a lot of these labor statistics and unemployment. The Fed's going to go faster on rate cuts if it's worried about unemployment or a stagnating economy, like slowing down. So recession, unemployment, whoops, got to drop the rates. Well, recession, everybody's been thinking it's recession or thinking we're in a structural recession right now, but it's light. And the labor numbers keep getting revised. So everybody, including the Fed, had been saying, you know, some of these labor statistics, it's troubling to see them revised. And we've even covered it here. They were missing 100,000 jobs. It came back a week later. Oh yeah, we're sorry. It really was 100,000 different. Sorry. Meanwhile, the White House took credit for creating all these jobs and they revised it a week later. So with all that jobs data and the potential recession, that was the 50% of me that said, you know what, he may go to 1/2 point there to protect the economy.
I get that, Tom, but what's the average person right now? So the stock market dipped after a historic Fed rate cut. Here's what experts think. Here's Fortune and what they think why this is taking place. So Federal Reserve cut the rates by 1/2 point, calling it a move to demonstrate officials' confidence that the labor market can stay strong with appropriate recalibration, despite the Dow dropped 1/4 basis point. And Robert Frick, corporate economist at Navy Federal Credit Union, noted that 1/2 point cut is an admission the Fed is behind the curve. The market reaction saying the market has priced in a rate path that looks more like what an impending recession would require rather than the Fed's less aggressive recalibration. The Fed's outlook of 2 more 1/4 basis point cuts this year disappointed investors. Powell insisted that the U.S. economy is in good shape, but his comment that we're not going back to near zero rate caused unease. Watch this. Every time we've cut rates the first time, I just kind of want you to think about this. Historically, when there's been these climbs of rate increases, and then there's the first rate cut, how much does the stock market drop after the first rate cut?
Historically, the market usually reacts down because the market is usually talking about what it needs and the economy is showing what it needs. And when the Fed finally responds, usually the Fed's, there's 2 theories, Fed chase and Fed ahead. Fed usually chases because Fed looks at history. The Fed reacts to history, so the Fed is chasing its tail. Whereas the stock market is always speculating, it's always ahead.
Yes, exactly.
The federal fund rate has increased 10 times in 14 months. I think it's 11 times in 16 months. So if you look at that, that's the cycle that we've been going. Bam, we went up. Stock market valuation and performance after Fed's first rate cut. So the first rate cut happens, and then it shows the average of how much the decline is, 20.5%. That's the average. Not after the first day. It's 94 days or 20 days or 437 days, but after the first rate cut, the market tanks 27.6%. In 1980, it dropped 2%. 1981 dropped 22.6%. 84 dropped 1%. 89 dropped 8%. 95 dropped half. 2001 dropped 42%. Okay. After the first rate cut, which is what, 1 year and 9 months. The first one is 3 months. The third one is 1 year and 2 months. And then the 55.5%, that's how many years? That's 1.5 years. And the 24.2 that we went through was in roughly 7 months, right? Give or take, that it dropped 24.2. So if on average, if we go based on this, there's going to be a 20.5 market correction within 3 months to 18 months based on history. That's what this is telling us. The question then becomes the following. How different is this than others? The average person is going to ask, how does this affect the housing market? Number one, mortgage rates may not drop much further. A lot of people are thinking it's going to drop. It says no. Although mortgage rates have decreased to 6.2, their lowest since February 2023, further drops will likely be marginal as the rate cut may already be priced in. Wells Fargo's economist predicts that rates remain around 6.2 by the end of the year and could fall to 5.5, still above pre-pandemic levels. Number two, lower rates could drive higher home prices, which we know that. Lower mortgage rates might attract more buyers, increase competition, and a limited housing supply. The first-time buyers are especially impacted, and many regret not buying earlier. That's what they're saying. That sounds like a realtor, though. You have to keep in mind. Number three, drop in rates may spur more housing supply. Make sense? And number four, affordability remains a major challenge. Even with the lower mortgage rates, affordability issue persists as home prices have surged by 50% since 2020, far outpacing income growth, which is what the federal guy was talking about. So what is different, Tom, about this rate drop that we have, 0.5 basis point, versus what we've had in the previous 10 we looked at?
Well, the last three that we've had, so 2019, it was COVID. We had dramatic economic impact. Go down to 2007, 2008. The housing market crash, dramatic economic impact. We have not had a dramatic economic impact. Have we had an oil shortage? No. An oil embargo and oil goes to 140? No. Have we had the recession of 2001? Remember, that was talking 644 days, so that was almost 2 years. 2000 to 2002 was the recession that was in. There hasn't been a dramatic economic impact this time. Like COVID caused havoc, and 2008, the housing market caused havoc. And what's interesting is they are saying that there's another 0.5 point coming this year. When the Fed also signaled that, it actually made this worse, because that tells, oh, not only are you taking a half, you're telling us quarter. So you're going bang, bang, bang. The market is reacting, oh, so the Fed is believing the recession story. Everybody's looking for the economic impact. Where is it? Are we going to admit that we're having a recession right now? Check this out. When they say refis are up 35%, you have to remember the number of houses available to refi. Look how low it is compared to the 20 million houses available to refi in 2021. Why? Because there's been no transactions. So when they say, they won't say numbers. The real estate industry won't say numbers, Pat. They're only saying refis are up 35%. 35% over last year is still up over nothing.
From April of 2022, how many realtors and loan officers didn't make it?
So many. I would imagine you have to have dramatic shift in the part-time, because realtors are 1099s. They get a license and then they just disappear. You know what I mean? There's not a layoff. So that's the interesting thing, that whenever you're looking to see layoffs, if Wells Fargo lays off mortgage administrators, like a mortgage officer, loan officer, you can see the layoffs, Pat. You can't really see what happens because they're 1099s and they just kind of go to a side hustle or disappear, because you don't lay off realtors. They just stop producing.
47% of realtors didn't do a single deal last year. 47% didn't sell one house last year.
I believe that because it comes down to the Pareto principle, the 80-20 rule.
The median number of sales was 2. How do you live on 2 sales a year?
Insane.
You don't. You do it part-time, or you're pretending to be a realtor when you're not really one. I've seen all this in Miami. You got the fakers and you got the doers.
The rates are now down to 6. But take a look, the last time it was 6 in 22. To get activity, we really got to get back down into the 5s, because we've been above 6. The guy from Wells Fargo is right, but he's not right. Because take a look at what's happened already. He was saying 6.2, Pat. Take a look at this.
Nothing.
Right. But the 20-year is 5.9, and a 30-year fixed VA, and the 30-year fixed 6.2. And this is 760, so we're not doing anything crazy here. You know what I mean?
I'm looking at this report. Since the new commission structure is changing with real estate agents and loan officers, it suggests that the agent count in the U.S. could theoretically decline approximately 300,000 to 600,000 people, okay? Which is roughly 60 to 80% of current NAR membership of 1.6 million could leave the industry. And by the way, this is one of the ways I saw it with real estate and loans. If you can stick around, the market's not going to stop selling, $1 million homes, $5 million homes, $10 million homes, $20 million homes, $500,000. It's not going away. But a chunk of them, that 28% of people the 28 months of not making money and selling homes and refis, that filtered out a lot of people.
I don't know if there's a profession out there where you need to look the part and fake it till you make it more than being a realtor. You have to drive a nice car. You're driving clients around. How are you as a new realtor going to compete with the big dog out there that's listing $20 million properties while you're trying to do a rental for a $2,500 property? You got to drive a nice car. You got to have a nice watch. It's literally smoke and mirrors in this business. But the people that deal with the ups, the downs, the left and rights, the people that I've been seeing realtors since 05, 06 in that world for the last 20 years, the same people, the guys and the girls that stick it out, that basically save their money, reinvest in the business, and are not just using all their proceeds to look cool, they stick it out.
You don't have money, you can't buy that because it's a cash deal.
Yep. Mm-hmm.
Everything right now, to all the people that made fun of people that are saving money, if you don't I said to this guy, I said, Tom remembers what I was making. You know what I was paying myself at? The first 2-3 years of starting an insurance company, I didn't pay myself anything. Jen and I lived in an apartment at the Summit in Woodland Hills. Literally, regular apartment at the Summit in Woodland Hills, right?
Truth.
Yeah. And then by the third year, I'm paying myself $80,000, $100,000 a year. That's nothing. My expenses, I'm barely making it, right? And then we start going and going and going. I start paying myself a little bit. I've never been the highest paid guy in the company, but we always had cash. So we need to invest into bamboo. We had cash. We need to go raise money. We didn't give that much equity because we had cash. Every time we had cash to reinvest, the mistake in every business, but it's so common in the real estate side, is they don't value cash. It's all go, 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 not realizing every 5 to 10 years, shit happens to the real estate industry for 2 years. So if you do it right, you can really end up building something like Keller Williams did, but it's only if you're thinking long term.
Treat the company's money like it's your own. Oh, okay, cool. Like just because this guy's got hundreds of millions, I
shut the lights off in the bathroom.
You better, buddy, or else you'll be sweeping the bathroom floors from now on.
There's a reason for that.
But there's also things like, cash is king. Save that money. You never know what's around the corner. When the tide goes out, we're going to see who's actually being smart with their money. So it starts from the top, and whether it's an organization, whether it's the head of the household, if you sort of set the tone, this is how we handle money here, guys. We're not going to just be lavishly spending when we can be saving, because when the time is right, we're going to have this opportunity to buy something very unique for the company that Pat will announce soon. But at the end of the day, you have the pretenders and you have the professionals in everything. You have the people that want to look rich, and you actually have the people that are actually want to be wealthy or are wealthy. And there's a significant difference. The bottom line is this for me: you have sprinters and you have marathon runners. The people who are playing the long game are the marathon runners like Pat. They know you said time and proof. Test of time, 5, 10, 20, 50 years, you're going to figure out who actually was good with their money or good with their morals and their values. The sprinters, they're going to look good for a year, for 2, for 3, but at the end of the day, when the market shuts down or they basically run out of money or the economy tanks, boom, the marathon runners are actually going to show who actually saved that money.
Tom, this rate cut had something to do with unemployment?
The Fed uses rate cuts. If inflation is high, what you do is you raise the value of the US dollar by raising interest rates.
Yeah.
Mm-hmm. When unemployment starts getting too high, you lower rates so that businesses can get loans for sensible purchases, building a new factory, building a building, adding equipment. You see what I mean?
Gotcha.
Sensible. And they're supposed to delicately turn the dial. Kind of like, have you ever been in a hotel where if you turn that shower just 1 inch, it's way too hot, and you turn it another half inch, it's way too cold? Yeah. Think of that's the way that a sensible Fed is controlling interest rates in our economy. Just think of it that way.
Gotcha.
The Fed, Jerome Powell, he's got one main job: control the economy. He has two basically things that he does to control the economy. Number one, he has to deal with employment and unemployment. He has to manage that.
Yeah.
And the other thing is managing inflation.
Should I be stressed out? Someone just shared this video with me and I'm sitting here saying, what the hell is this all about? Am I supposed to now lock it up and just not spend any money and not do anything? Here's all I'm saying to you is, I subscribe to the concept of only the paranoid survive. I'll give you a story and wrap it up. Last night, Sunday night, I'm playing Monopoly with my 2 sons and my daughter. One of my sons decides to play very conservative, and he's keeping and hanging on to all the cash. He's not buying any property. It's like, no. So he's got the most cash. One of my sons, every time he gets cash, he's building a house. I'm going to build 3 houses on Indiana, Kentucky, and this. I'm going to build 3 houses on Vermont, this and this and this. And we're like, dude, this guy's down to $200. And then we land on it. Oh, you owe me $320. Okay. Oh, you owe me $320. It's my turn. I'm going to buy 2 more houses and I want to build on this one. Okay, boom. Oh, you owe me $550. I thought it was $320. I built 2 more houses. I'm going to go build now 3 hotels. Okay, how much is it? Oh, you owe me $900. Damn. And guess what? You don't have any money? I'll take that Park Place from you. But that's not fair. Or you can do it. So all of a sudden, he's got Park Place, Boardwalk. He's got everything going on right now. I want to build Park Place. And guess who lands on Boardwalk? Daddy. I land on Boardwalk. You know how much Boardwalk is? $2,000 that I don't have. So I got to give him 4 railroads, and luckily I was able to negotiate a good deal. I give him electricity, I give him all this stuff, and I got to give him a couple, properties that I have. And next thing you know who ends up winning? The guy that took a little bit more risks than my other son did, and he wins the game of Monopoly. What does this mean? Does it mean go spend all your money right now? No. All it means is if your tolerance for risk isn't high, don't take it. But don't expect to make a lot of money if you're going to be super conservative. But if you have some tolerance for risk, this may be a good time for you to be shopping certain things, because the next 3, 6, 12 months, people may be very scared. And FYI, don't let the arrogance of people saying everything's gonna be okay, the market's not gonna crash, it's gonna be a recession, soft landing. Whenever anybody says that, including myself, just kind of say, I don't think anybody knows what they're talking about. I'm just willing to listen to everybody. All I know is only the paranoid survive.
Everything about money is a doubles game. If you take 1,000 and you double it every year, what happens? 1,000 goes into 2, 4, 8, 16, 32, 64, 256, 5, 12, $1 million. $1,000 is 9 doubles away from $1 million.